Welcome to Real Cash Flow, the only show that takes you full circle with your money, covering stocks, bonds, commodities, currencies, crypto, insurance, and real estate. I'm your host, Andrew Michael Arroyo. Let's get started. Welcome to today's show. Today is a special episode on real estate investing, and I am joined in the studio by Gary Giffin. Gary, welcome to the show.
Thank you, Andrew. Glad to be here today.
Excellent. Well, let's dive right into it because this is a topic I'm extremely passionate about. I know you are too. We've spent the majority of our working careers. For me, it's over 25 years. I know for you, it's over 20 years in the real estate space, and specifically investing, brokering, buying, selling. We've had the privilege of dealing in all of the different varieties of real estate. So I think for the listener today, they're going to gain a lot of insight and knowledge on the different types and ways that you can invest in real estate. And I'll just set the stage with the basics. Most people think about real estate investing and they think about residential, they think about commercial, they think about development, they think about possibly buying some stocks or REITs, real estate investment trusts on the exchange. But there's so many different ways to invest in real estate. And I want to take them down one by one. I want to debunk some myths that are out there that people have unfortunately adopted because of what I like to call those late night TV personalities way back in the day that got on TV promising people they were going to get rich if they just, put $1,000 down and went and bought some vacant land in the middle of nowhere. All the charlatans that exist in that side of our industry, sadly. And then with the common knowledge of, okay, let's go ahead and just get a loan. Let's buy our first starter property, our first investment, and let's just, slave it out for 30 years and pay off that mortgage. And then we're going to have some cash flow at the end of that rainbow. And then going to the extreme of the commercial real estate, the most advanced professionals out there that are able to navigate the different market cycles, really capitalize, have above market rate returns. And how do they do that? And how can the everyday listener participate in those investments? So we have a wide spectrum to cover, but it's going to be very, very quick and efficient as we go through today's episode. So Gary, let's start with the basic because you spent so much time in your career in residential. What are your thoughts for that first investor that just wants to have a piece of property and get some cash flow? Where do they start in the residential space?
Yeah, great question, Andrew. I guess our market that we're looking at today is so volatile, and that's such a great question. Everybody wants to know when's a good time to buy, and where should I buy? We've been lucky, Andrew, to be in kind of a bubble here in San Diego, where we're talking from today, and the rest of United States, you really have to kind of study to see what's going on in those areas where there's more land and people can actually build. Here, you're not going to build something. There's not a lot of land left unless you go and find an old house that's been around. Old here would be like 1940s, 1950s, and you're going to scrape it and put condominiums on it or a duplex or something that you would use as an investment property for rental. So it really depends on the client, and are they buying it for their kid to go to college and then using as a rental? Get a lot of those. Are they looking for a beach property, west of Highway 5? Kind of what their game plan is over the years. Is it going to be an investment, long-term investment for a rental, or are they going to use it as a vacation home, stay in it 1 or 2 months out of the year and rent it the rest of the time? So a lot of questions. Where do they want to live? Do they want to be in a desert climate with a lot of heat to keep their bones dry, or do they want to be closer to the ocean where there is actually a lot of fog, certain times of the year, and it's very wet and humid. So there's a lot of questions to ask, and certainly what their down payment is and how much money they're willing to spend to keep that property going each month. Luckily for us, Andrew, we do have a great rental team aboard AARE that does property management, so we can turn that property over if they want to be hands-free and not have to worry about phone calls at the night during the night about somebody's got a plugged toilet and they need to have somebody come fix it. So there are a lot of different questions to figure out what they're looking for and what they need and what their price range is before going forward.
So I'm so glad you brought up that perspective because that is the exact perspective of what I would call 80% of the Western world that is seeking to break into real estate investments. And what they've done, unfortunately, is they've mixed emotions with financial outcomes. And what I mean by that, just as you described, those conversations are happening every day between a real estate agent or broker and their client. And when somebody gets into the investment game, they start thinking about, well, do I want to use this as a vacation rental? Do I want to be here? Do I want to be there? And there's some emotional consideration to the property rather than simply looking at the math, the numbers. And this is what I want to help debunk and help listeners to separate in their investment portfolio. Residential was always designed and developed to live in. Simply that, just to live in. A home for your family, your loved ones, shelter, etc. It was never designed to be an investment. Now, the Western world has made it an investment because it's the entry level into breaking into real estate investments. It's what people can afford, and they can utilize great loan programs based on 30 years and get in with smaller down payments. But when you really look at the numbers, and this is what I'm going to take time over these next few episodes to drill down on for people. And I'm going to give you a little homework. I want you to do a little math if you own some real estate. I want you to take today's value of the real estate that you own. And then I want you to look at all the cash flow, all the rents that you collect. And I want you to back out the property taxes and the expenses and the maintenance and all that. And I want you to get down to that true net operating income. It's called NOI, your bottom line net dollar. And then I want you to go back to that current market value. And I want you to look at what percentage of the current market value are you actually earning on your investment. And not knowing the property, maybe not even knowing you personally, I'm going to guesstimate that that return is going to be between 1 and 2%. That's it. And it's a sad fact, but that's the reality of most people's residential investments. Now, what's happened in a lot of boom economies and over the last handful of years is the appreciation in all this residential real estate has gone up so much that the cash flow is not as important because people say, well, gosh, I bought this at 500. It's now worth 800. Man, I've made a ton of money. But that is abnormal. That is not usual. And when you're only banking on appreciation that is not backed up by cash flow, eventually those prices will retreat. The cycle will correct that. And eventually the cash flow will come back into equilibrium with the price. So unless you plan to sell it and time the market and you're a genius in doing that again and again and again, ultimately it's not going to be a great investment from a cash flow standpoint. So now, Gary, let's switch to commercial real estate because commercial real estate is specific to cash flow and returns. And as a matter of fact, the value of commercial real estate, different than residential, is predicated on the cash flow called a cap rate. And I want the listeners to think of a cap rate just like an interest rate. So if I put $1 million in the bank and I get 5% interest, I'm going to get $50,000 a year for doing nothing. I don't have any tenants, toilets, headaches, just nothing. I just park my money, get my $50,000. Now, if I buy a commercial property for $1 million and it has what's called a 5% cap rate, very similar to an interest rate, when all the expenses are paid, my net income should be $50,000, 5%. So it's very easy to understand cap rates. But what happens is when the interest rates go up like they are right now, the cap rates have to follow. Because if I can get 5% in the bank for doing nothing, why would I buy a piece of property to only get 4 or 3%? That wouldn't make any sense. I'm buying myself a job. But if I can get more than I could in the bank, if I can get 6 or 7%, well, then now I have the incentive as the investor to go out and buy a commercial piece of property. So, Gary, the difference between residential and commercial is simply that commercial was designed for cash flow. It was designed to be a good investment from the get go. And when you go to sell it, you have to offer the next investor a good return on their money. So the valuation is dictated specifically on the cash that it's yielding. But what do you see as the biggest obstacle for somebody who recognizes this truth and says, well, yeah, I don't want to be in residential. The only reason I'm in residential is because that's all I could afford, but I really want to get into commercial. How do they do that?
Well, I think the best way to do that now is we've all heard of REITs, and that's something that I know that you've talked about for many years, and now it makes sense to actually, find a REIT and do it that way because if you look at these commercial properties, which I've scanned here for a long time, and you look at the cap rates and you put the numbers in, they still don't make sense. I think the sellers are still thinking that, well, the market's going to come up to what their price is, but they're not pricing it correctly, and the cap rates that these commercial brokers are putting up don't even match when you actually put the numbers in and you start adding in, oh, I'm going to need a roof in 2 to 3 years, or I've got cracked cement that needs to be repaired, or whatever it is. Those cap rates don't work, and if you figure it out and use a correct Excel spreadsheet, it's just not good investment opportunities. So I think we've talked about syndication for many years, and we've participated in that, but I see the trend now moving towards the REITs.
And let's talk about the difference real quick. A syndication is typically set up as an LLC, like a partnership, but essentially it functions up to 99 investors. So a lot of people do a syndication with their friends or colleagues or people that they know. Usually 5 or 10 people get together and go buy a piece of commercial real estate, and that's a syndication. Now, once you go above 99 investors, you get to 100 plus. That's when you can qualify to become a real estate investment trust, or a REIT is what they call it, REIT. Now, there's public REITs, there's private REITs. We are a public company. Our organization, called AARE, is forming a real estate investment trust, which we will launch later this year. We've done syndications in the past, and now we have over 100 shareholders, so we can qualify to become a real estate investment trust. And one of the benefits of a REIT is that once you've elected that with the IRS, you actually pay no corporate income tax, and 90% of all the income must be distributed in the form of dividends. So this is very advantageous to anybody who owns shares in a REIT. Now, there's public REITs and there's private REITs. The public REITs have the benefit that if they're on an exchange, you have liquidity, which is great, because when you think about real estate, one of the challenges is liquidity. If you want to go sell a residential property and it's a cold market, you might be looking at 6 months to get rid of that property. And the same for commercial. It can be even worse in a cold market. It might be a year or two to get rid of that property. So one of the benefits of owning public REITs is that they trade on an exchange. You have to stomach the volatility, but with volatility comes opportunity. And the fact that you can liquidate any day of the week, anytime a stock exchange is open, is a huge advantage versus actually owning physical real estate. So there's that advantage. Now, there's private REITs that don't trade on an exchange, but they do have redemption periods. Some of them are quarterly or annually, and syndications typically lock up your money for 7 to 10 years. Sometimes it's less. But the point is, you're parking that money and hoping that the managers know what they're doing and that you're going to get a good return on your investment. Versus with a lot of REITs, you have the ability, again, quarterly or annually to get out if they're private, and if they're public, you have that daily liquidity on an exchange. So let's transition and let's talk about some of the other alternative investments, if you will, because I see people get lured into this stuff, and it bothers me because I know they're being taken advantage of, into development, for example, buying some vacant piece of land that's dirt cheap, and then they're going to have a spec builder try to build something and they've never done this before. They're going to invest with a group of builders that have always had a dream to build residential property, and they don't time the market properly. And we've all seen this story again and again and again. We see properties half built, or they get built, the workmanship is shoddy, and then it doesn't sell for what they thought it was going to. And here they get, half their money back or none of their money back, depending on if the builder forecloses. But Gary, let's talk about development. I'm sure you get pitched, right? People have wild ideas and they call up and I've got this piece of land, or I'm interested in that. I've never built before, but the desire is there. People see that real estate is a solid investment. They just need proper guidance on where to invest their money. So what do you do when you get that inevitable phone call with that land speculator or somebody that's got this great idea? What guidance do you give them?
Land can be really tough, and my first response is, do you have a lot of time? Because depending on the community that you're going to be investing in, and here in San Diego, we have a lot of sub communities, and as you get closer to the coast, then you have to deal with a lot of different cities, not only city of San Diego, but maybe the city of La Jolla, Coastal Commission, and all of those uh, will ask for your plans. They want to see them. They want to make sure that you've got a good plan put together. And if you're up against the coast, well, then that could add another year or two, possibly even more, uh, depending on what you want to do to that property. And does it have a seawall, or whatever it is? It could add a lot of time. So that investment can actually get out of control sometimes because you projected a certain timeline, and maybe you've got a loan on there that you put on that property to pay for all of the construction. So there's a lot of costs that people don't think about, and land is not for the weak at heart. It's definitely not as easy as people think.
It's the most risky part of our industry. I've seen the most people lose the most money trying to develop land, spec building, developing, and it's all predicated on cost budgeting and timing the market right, understanding absorption rates and demand. And unless you have tremendous experience or come from a background or family or connected with people that have been doing this for decades, I wouldn't touch it with a 10-foot pole. And that's coming from somebody who's been in the industry 25 plus years and invested in pretty much everything you could invest in real estate. Now, what I want to encourage listeners to consider is simply the conservative way to break into real estate if you're not already in real estate. If you own some residential real estate, my encouragement is to step up to the plate and go to the major leagues, get into commercial real estate, because ultimately it was designed for investment. You may have had a great run in residential. Congratulations. That's awesome. You timed the market right, or you were patient enough and diligent enough to hold on and pay down that debt. Congratulations. That's awesome. But at the end of the day, take a 1031 exchange, move that money into commercial so that you now have an investment that was originally designed to kick you off the cash flow. So what I see with residential that commonly happens is people buy that first condo or single family home. It works out in some capacity. It may not give them the cash flow. Sometimes it's even negative cash flow from what the debt financing is. But because they see some appreciation, they get encouraged and they go buy one or two or three or four. And now here, 20 years later, they own these four residential properties versus somebody getting together with a couple friends and buying an apartment building from day one, which I believe is going to be a much better investment, and having that cash flow and then simply 1031 exchanging into larger apartment buildings as time goes on. That is where I've seen ultra successful investors have great success. So, Gary, what are some of the other roadblocks that you see when somebody calls you up and says, "Hey, I want to invest, and I've got 100 grand or 200 grand." I mean, what are their options? They don't really have much of an option to go buy a commercial building, do they?
Not here, not in our state, not for that price. I'm not sure where you'd go in the Midwest to use, that sounds like a lot of money, and it is, but not here as far as investments. And yeah, typically you're going to want to group together and find, like you said, somebody that's put together a REIT and a plan where you could take 100, $200,000, depending what the buy is, and use the group to buy a property that you couldn't afford, maybe 23 to 30 million, depending on how many doors it is. So you want to find something that's going to be a really great payout and that you don't have to worry about, like you said, tenants, trash, and toilets. You just want to make sure that you're going to get a good return on your money. And it's going to have to be over 5%, right? Because that's what the banks are paying right now, or at least close to that. So that's kind of where we're heading right now, is looking into those REITs.
And let's talk about the stack of risk. I think it's good for listeners to understand. So they think residential has the least amount of risk. In my opinion, it actually has a lot of risk because if you're not buying it for a personal purpose, well, then it is very subject to the market cycle. And if it's not cash flowing to cover the debt, you can get yourself in some hot water like we saw in 2008 and 9, where you had a lot of people that bought a high price and they couldn't afford the mortgage, and the rents wouldn't cover the mortgage. They had to give up those properties to foreclosure. Whereas in commercial, you don't have that risk in the sense that your underwriter, your bank, is going to be loaning on the asset. It's not going to be loaning on you and your credit and your tax returns. It's going to be loaning on the property. So it's looking at what cash flow does this particular property yield. And based on that, we will give you this type of loan. And typically the loans are 60%, sometimes higher, loan to value. So you're putting more down, which again prohibits a lot of people from investing in commercial because let's say it's a $2 million building and they want 40% down, you got to come up with 800 grand. So if people have that, that's great. But typically you got to pool with some friends or family members and invest. Then you need the management of it. You need competent managers to oversee that property. But it is designed for cash flow. And that's the big difference. So when we talk about risk, let's stack them up. I'm going to put residential actually in the middle. It's not going to be at the bottom. I'd put multifamily and apartment buildings as the least risky, and they call that core investing. Then there's core plus, which would be something like retail. You're taking a little bit more risk, but if you've got some nationwide tenants and you buy a little strip mall or shopping center, and you've got great long-term anchor tenants that are Fortune 500 companies, pick your favorite products that you buy. Well, then they're going to be backed by that corporation's balance sheet. So, typically default's not going to be there, but there is risk because sometimes you see a lot of vacancy in those small strip centers. And then going beyond that, you'll have, value add, and that's properties that need some improvement and they're not necessarily stabilized. They might have some vacancy, regardless of what type of commercial real estate, if that's retail, industrial, multifamily, flex, office. If it's a value add, that means you have to put in some money. That's like a rehab, a fixer at the end of the day. And then finally, the most risky, the opportunistic, and that's typically development and land speculation. And that's what we've already encouraged people to stay away from unless you really know what you're doing. So, Gary, when you think about your clients that have over the years all come to you and said, "Hey, Gary, is it a good time to buy?" That's like the number one conversation that people have with their agents or brokers, and they want to know. And you have to break up the market into several segments because whether it's a good time to buy in residential may be completely different than if it's a good time to buy in commercial. And if it is a good time to buy in commercial, for example, right now, I believe is an incredible time to buy office buildings and some multifamily apartment buildings that have been discounted. It's not necessarily a great time to buy in residential if you're looking for investments because interest rates are high, the prices are high, and it's been a big run up and there's significant risk to the downside. So how do you address that question, that inevitable question you get from your clients? Is it a good time to buy?
Yeah, that's a great question, actually. And what's interesting, Andrew, and I know you mentioned this in a different podcast, is all of the commercial mortgage loans that are coming due in 2024. over 600 billion, I think it is. Maybe it's more than that now, and they'll probably end up pushing that forward. So it's going to be a good time to buy in that commercial sector. I believe, and I think you think the same way that I do, is there's going to be a lot more opportunities. So for somebody that only has 100 or $200,000, that's going to be the proposition is waiting for that right piece of property and making sure that we've got enough investors ready to go when we find that property so we don't lose it.
Yeah, it brings us back to 2008 and 9 and 2010, where we operated a syndication. It was a foreclosure fund that was what was hot. I like to say today's market environment reminds me in residential 2008, 9, and 10, that kind of opportunity that existed then now exists in commercial, which is incredible. It's like a 50% off sale in some markets. And it's going to continue based on all that debt that's maturing that you just mentioned, Gary. So this is prime time. There's always a good time to buy real estate. The question is where and what type of real estate. So buying is not the issue. It's if you have the capital, get that capital working and generating some interest and some cash flow for you. But making that choice, that's always the challenge, right? Figuring out the geographic locations that are going to appreciate based on demographics or demand or lack of supply. And then figuring out the type of real estate. Because as I mentioned, this is quite a paradox that's going on right now. Very rarely have I seen in my 25-year plus career where one segment of the market, like commercial, and these two specific pieces, these types of commercial, multifamily and office, are down for the count. Yet residential is way up and holding strong, even though those investments do not pencil. You're not seeing in the last couple of years, you are just not seeing a lot of investors or big investors buying new residential properties because they don't cash flow at the end of the day. It just does not make financial sense. Plus, they've already had a big run up versus these multifamily and office buildings because of the rise in cap rates that pushes values down. So that's something that's hard for people to understand is that as cap rates go up, which follow interest rates, values actually go down. And why is that? Well, because the cash flow that's coming out of those properties typically hasn't changed, might change a little bit year to year, but assuming that that cash flow is exactly the same, well, if the going rate was 5% and then 2 years later it's now 7%, the new investor is expecting that 7%. So therefore, something has to give, and that's where the value gives because the cash flow, the monthly cash flow it's yielding has not changed. So there's the big opportunity right now. And as we wrap up today's show, I just want to encourage people. You have a few options moving forward. One, you can do it yourself. And if you've got the talent and you've got the time and the commitment to be a property manager, God bless you. Go out there. We'll try to coach and educate you and give you all the wisdom that we've gained over the years. And if you just prefer to control things yourself and do it yourself, that's the best lane for you to be in. Unless you're well capitalized, you'll probably remain in the residential space for your lifetime. If you can 1031 exchange into some multifamily or a commercial asset, I would suggest being diversified with a multi-tenant asset, not a single tenant office building, for example, or a single tenant retail building. Very risky if that one tenant goes away and you're stuck. Option number two is if you play well together with a team and you've got some friends, some colleagues, some family members, and one of them has some real estate experience. Great. You can pool together, form a syndication. I'd consider an LLC so you have some asset protection on that specific asset. And then you can go out and buy a property collectively with your friends or colleagues. And that's what a classic syndication is. And pull together $1 million and go leverage it 50-50 and buy something for $2 million. And you can get started that way. And finally, if you just simply want to write a check and say, look, I know real estate's a great investment. It's a great inflation hedge. It appreciates over time. Plus it kicks off great cash flow. I just want to be able to write a check and receive my dividends. I don't want the management. I don't want to know all the technicals. I want to go find trustworthy people that I can depend on, invest with them, and receive my return. Well, that's where a real estate investment trust comes in. Or you could find a public real estate investment trust that's already trading on the exchange and you could invest. And there's certainly a lot of them out there. There's probably a good dozen big real estate investment trusts that are on the public open market. But again, you are subject to that volatility of the general stock market and you are buying into a pool of assets that you don't quite understand unless you're going to take months, if not years, to really analyze every single property that that REIT already owns. So, one of the benefits of getting with a manager that has a newer real estate investment trust or one that's growing is you can quickly analyze the properties they either own or they plan to buy, and you can really get in on the ground floor. So, hopefully, that gives you three great choices on how to deploy the money. But again, my encouragement for everybody out there is step into the major leagues, look at commercial real estate. That's where the prime opportunity is today. Stay away from land speculation and the late night TV people are on social media promising you you're going to get rich if you go through their course for 30 or 50 grand. That's a bunch of charlatans. It's a ripoff. Don't get sucked into that. Don't get sucked into tax liens and all these wholesaling things where you're going to assign contracts to somebody. Simply save some money, find some competent managers, and invest with others that know what they're doing. Any final words as we wrap up here, Gary?
Just make sure that you find somebody that you can trust in this real estate market. Um, Both you and I know, after being in it over 20 years, there's a lot of people that come and go all the time. So find somebody that you can trust, especially with that kind of money, and build a long-term relationship with them. Sit down with them, talk to them, and do some studying, do some education, making sure that you understand that you're going to be, building a long-term relationship with that company that you're going to be working with.
It's sound advice. And there's nothing better for real estate investors than knowing that your investments are also doing well in the community. And that's called impact investing. We'll cover that in future episodes. And we like to call it the triple bottom line, right? So you've got your financial return, you've got your community return, and hopefully there's a spiritual return where you're helping others and developing those relationships with tenants and all the people that are essentially paying into the cash flow that you're receiving. You're actually blessing them as human beings and you're creating an environment for them to thrive as human beings. And it's not just all about the money. So hopefully this message has blessed you and you have learned more about the variety of options out there, and we can help lead you to make those good decisions in your real estate investing. May God bless, and we'll catch you on the next episode.